Hey guys, happy Sunday. Welcome back to another Sunday video where we get ready for the week ahead. This is a weekly video where basically I walk through things like the indices, metals, currencies, etc. Things that I'm watching for myself, ideas. We talk through some of the macro data. So hopefully this gets you caught up to speed on everything you need to know going into this week. If you enjoy these sorts of videos, I do make them completely free on YouTube. All I ask is that if you could do me a big favor and like the video or thumbs up the video. And if you're new here, consider subscribing. We're past 400,000 subscribers here, and someday I hope to get the channel to 1 million, but we'll get there slow and steady, just like good trading. Let's go ahead and jump into some charts here. But first, we're going to get to the charts, but I promise. But I want to just show you guys a little bit of something that I've been going through here in my trading, and I want to discuss this because this was frustrating. So this is my year-to-date performance, and what you'll see here is that we were very, very smooth, and in just a few short weeks, I gave back a huge amount of my profit and then gained a bunch of it back. But I want to talk about what happened here and just let you guys know a little bit of my experience during this time. This was very frustrating because the big drop-off actually came from a poor slippage exit on that Monday morning where the market dropped. I'll show you really quick what actually happened, but before I do, again, just wanted to show you that trading is very difficult. And I was early on the idea of getting long on the Nasdaq, and I'd calculated risk going on, but big slippage can really drop off, and result in big losses. Fortunately, however, a lot of the same ideas that I was in, I was willing to or able to find a new entry point, and those entry points have been rockstar. I'll show you my positioning this morning here on this video on things that I'm currently in, but just wanted to show you just a rough time because even though I've been doing this for years, there are times where you just are off and wrong about something and too early to an idea. So just wanted to show you that. There's my up-to-date year-to-date performance. Now let's go ahead and take a look at the culprit here. It was actually QQQ, and I was long Qs going into the weekend. And before you get all, no, you shouldn't have held it into the weekend on me, just give me a second, because oftentimes, there's a lot of positive gap opens too. It just so happened that on this big Monday morning, futures traders and ETF traders like myself trading QQQ and futures, there was a very wide gap in the price action. And as soon as it opened up, I got filled down in these areas just before the market started ripping up. So as you can imagine, I had a good size positioning. My risk was, somewhere between this gap. And if you were a futures trader or an FX trader, didn't matter. As soon as the market gapped open, the price was way down here. So I ended up taking a very larger than expected loss. And this is trading. Trading, sometimes the markets are not going to fill you exactly where you want to get filled. And so I learned a painful lesson about slippage. It can be very, very big. But fortunately, I was able to, right around the open, I liked the setup quite a bit, especially once we had that services PMI number that came in very nice to combat the fears about recession. I ended up getting long several things, and in the end, I think I might actually be better off because of it. So this is a list of everything that I am currently long. In the main account, I'm long the semiconductor ETF. This thing has been a beast. The S&P 500, SPY. IWM is the Russell 2000 index. And then I bought some individual stocks for the first time in a very long time. Because I typically only like to buy stocks if I can get, a 10% correction in the S&P 500, which technically we did. So, and then if you take a look at the NASDAQ was actually down even like 16, 15%. And I think on the futures exchange rate quotes, they were actually even lower. So really interesting, just kind of getting an idea of where everything is now. We've bounced back really well. And I want to talk a little bit about the indices going into this. First of all, the indices have ripped way harder than I thought they would. And again, I am bullish on these things, but we had about a 2-week span here where it was the holy grail of economic data. Now remember, the sell-off that occurred was because people were afraid we were going into a recession, and the big jobs data, the NFP that came out, that was really bad. That really got people so spooked into thinking, oh my gosh, the Fed has lost control, we're gonna go into a recession. And then we V-shaped moved back up because for the last 2 weeks, it's almost been like every single economic data point has come in very, very strong. let's do just a quick synopsis of what I'm talking about in terms of the quote unquote economic data, and I can show that to you. So again, it was kind of normal for the market to get all spooked up about this jobs data, because you can see it was a big miss. In fact, on that day, I was a little bit nervous myself. Oh my gosh, did the Fed actually misstep? But as the data rolled in for the following 2 weeks, we saw things like services PMI, which came in line, showing, okay, the economy is still growing in the services side. That's great. And then we saw retail sales this past week, which showed consumer demand, consumer spending is actually much better than expectations. And remember, I know it may be hard to read on your screen, but what we're looking at here is the forecast was 0.4%. We got 1% growth. Retail sales month over month. That's pretty aggressive. That's actually very strong compared to estimates. Then we keep going down the line and we say, well, jobs data, right? There was actually some evidence to show that jobs data is a little bit okay, right? We had the last 2 unemployment claims came in lighter than forecasts, meaning less people filing for unemployment. Hey, that's pretty strong for the economy. And then job openings, they've actually flatlined for the last 3 reports. So that's not bad, right? So we're seeing, jolts coming in and kind of staying steady. All of this is while we're seeing the progress that the Fed has wanted to see for a number of years now, which is inflation has been coming down very nicely. And I've drawn this chart many times, but the problematic period, I would call it, is when we came down in inflation, but then we started just going sideways. Now it seems convincing that we are actually seeing inflation cool down and now making that next wave, hopefully down to that 2% target that the Federal Reserve wants to see. All that to say, my rating for where we are with the economic data in line with, getting into a rate cut season, which could lead to growth again, I'm going to go ahead and give the data an A-. It's not perfect, but in terms of like what you need to see in order to see a soft landing, right now, everything that I've got on my my homework answers here seems like a pretty solid case for a soft landing. And so if I take that as my synopsis, I should be able to see it in the top setups algorithm, which we do. What we can see here, actually look at this, interesting. The COT data looks like a little bit more bearish for the S&P 500. But what we can see is if we go over to the data scanners, let's do stock indices for a second. This is actually interesting. We had a big swing on some of the scoring here. We might need to break down into this a little bit more. If we take a look at that, again, you've got GDP coming in better than expected. That's positive for stocks, right? GDP growth is good. PMIs, again, came in lower. This is incorrect. No, this is some manufacturing. Services PMI came in okay, right? So we got a 0 on that. 0 change, right? Came in line with forecasts. Retail sales came in really strong. CPI came in great. Core CPI a little bit hotter than expected, so not as positive. And then this is showing a very small difference between the 8-day moving average and the 2-year yield, but yields have been coming down very nicely. That's really good. The jobs data, we've got fresh data coming out pretty soon. That should be very interesting to see for employment in the month of August. But again, I think that if you're going to see a soft landing, what you want to see is economic data cooling so that the Fed can cut rates. They can say, okay, we're good to cut rates. But you also want to see it not crashing. And I think that that's why I say, we've got an A- report card here for jobs data, for economic growth. It's slowing, yes, but it has to in order for inflation to really meaningfully come down. But it's not crashing, and that is the key ticket. So anyways, in terms of my positioning, I shared all of these trades inside of our group. Let me show you those. So this is our Discord channel where I share all of my trade updates. So when I enter a trade or exit a trade or put a stop loss on something, whatever, I share all of my positions inside of our Discord channel. I trade indices, commodities, FX, and even stocks and options. So I do a little bit of everything as a fundamentalist. The cool thing is that it allows me to trade a very wide basket of things because, again, I'm basically looking at the macroeconomic data and then building out biases from that. Anyways, I went long the S&P 500. I went long the Russell 2000, as I discussed earlier. And so I shared all these updates, and I just wanted to mention that if you guys are interested in getting access to this, we'll leave a link in the description down below for where you can sign up. And if you use code YTVIP, we'll extend the sale that we had last week going on until the end of today. So this is YTVIP. Will get you 30% off of the memberships. So if you'd like to join the group, take advantage of that. The information will be left in the description down below of this video, but come join us. It really is worth the money. I'm telling you what, if you are somebody who is looking to learn this stuff, we've been overhauling the group, trying to make it better and better each day, really. On our team side, we've got there's several people behind the makings of this group, as well as the Edge Finder, which you saw earlier. And yeah, just wanted to mention that will extend that sale just to the end of today. So if you're interested in getting access to that, again, it is YTVIP. That's the promo code, and there will be a link down below in the description for you. Okay, so the S&P 500 here looks pretty healthy in my view. We've come down and we tested on the weekly chart. Look at this weekly chart. That weekly chart looks pretty obnoxiously bullish in my view. And here's why. Again, the bears in April took control for about 3 weeks, and then it hit this huge level of support where we had this like kind of hammer looking candle or this pin bar looking candle, and then buyers stepped in and really pushed it to the moon from there, right? And then now what we see happening is a similar sequence of events. You've got this very high level, key level of support structure here, and actually if we go ahead and let's copy and paste this. What we see here is we've also got this, right? So what we saw is price come down for 3 weeks, 1, 2, 3, and on the third week, it was go time. That is repeating the same pattern in April. Now, what's making me a little bit nervous about this is that in a true, in a healthy market, you're supposed to have waves both directions, right? And we are seeing waves to the downside, but they are incredibly short relative to history. And what does make me a little bit nervous is that this trajectory that we're on is definitely not sustainable, first of all, and it's also definitely not historically something that we see frequently. Like, in bull markets, you just don't see this rate of change, right? This angular growth that we saw in, periods like 2020 and 2024. And what's interesting to me is that you usually see these sorts of market, rips to the upside after a bear market, but we're not in a bear market and we haven't been in one since 2022. So, anyways, I am still bullish. So I'm not saying that it's a bearish case, but I am saying we've got to be a little bit cautious on where we're going from here. How much more can we expect this thing to just squeeze to new highs with no problems? Now, again, I will remain bullish until something changes in the data, but I just want to point out we've got to be a little bit cautious on that front. Anyways, we come down to this huge level of support. I bought heavily, several different things. And let me just be clear. I'm not saying I bought heavily to pat myself on the back, because I also bought heavily too early on some things as well. So I lost money. I've been very bullish on this market and lost money on the way down. I showed you that at the top of this video. I was taking several losing trades on the NASDAQ before I finally caught the really good entry on that Monday morning. I did buy not the absolute lows, but pretty dang close on things like the semiconductors ETF. I'll pull that up for you. So here's SMH, right? I bought that pretty dang close to the low. It gapped open that morning. I was live streaming, I believe, at the time, so I didn't actually execute at that position at that moment. But after the stream ended, I went and looked at things and I said, you know what? Especially with that services PMI data, I just don't think we're going off a cliff with this economy right now. And so I got back in long, and that ended up being best case scenario, because SMH is a very volatile ETF. It moves substantially, right? So this position is up from my entry 14%, which is a big move, for an ETF. We take a look at the SPY position that I'm in, and it has also moved quite a bit, but it's not 14%, right? It's more like 6%. So these two positions are kind of the monsters. IWM is another one. This is the Russell 2000 index, and I need to probably trim a stop loss on this one, but I like the Russell for a number of reasons. I discussed that on Friday's live stream a lot. I would encourage you, if you want to hear more about the Russell in depth. on Friday's live stream, right when I was joined by Chris Pulver on the show, we discussed the Russell 2000 index for a little bit there, and it might be worth your while. So, anyways, I like the indices on the long side. What I like about the S&P 500 is the reaction to this area has been so aggressive, but supported by the data, right? So it's not only a price action support bounce here that we're seeing. More importantly, to me, it's price action bouncing supported by several economic data points that I discussed earlier just a moment ago on the Edge Finder, retail sales, unemployment data, etc. So to me, you look at this, and I had people commenting, Nick, are we at resistance? Like, is it time to short this rally? And guys, here's the tricky part for me. If you're somebody who's bearish, we've blown through all the key levels of resistance that I've seen on this chart. Now, if you were somebody who was bearish, I got this idea. This actually rejected beautifully. If you were a bear here, you made probably a lot of money. But then once we started just nailing through the 38.2, and then we blew past the 50%, and then no problem at the 618% retracement here. To me, bearish price. Where is the bearish price action? Like, there's nothing here for me. Now, if you are bearish in general, and you don't think we're gonna blow through the highs, then I could see maybe making a case for trying to sell the rip back up to the high. Maybe this closes and then we just go from there. But for me, the answer is the economic data leans bullish. Company earnings lean bullish. I am bullish overall. And I'd be looking for, if I'm not already in this trade, if I wasn't in this trade, how would I be looking to enter? I'd be looking for something like a retest of this area, right? And looking for continuation, stops below structure, right? We're managing risk here. I actually probably need to, that's actually where I'm going to probably move a stop loss, by the way. I've been thinking about where I want to move a stop loss. If this is the area that I would like to buy or maybe even add to my position personally, I probably need to manage my risk by putting my stop loss below here. Because what if this week we see a big, lower high here, and then we just start to trail off and plummet back down to the lows? It's possible. I don't see the catalyst right now, but here's one that could be a catalyst. This week we have the big Fed meeting, Jackson Hole Symposium, where the Fed is set to lay out their plan for the rest of the year. It is a big Federal Reserve meeting. And if they come in with something that's really hawkish or something that is a change on their view on the economy, if they're seeing something differently, it has the potential to be very volatile in either direction. Now, here's my personal view on Jackson Hole Symposium. I think they're probably going to signal everything what everyone wants to hear, right? I think there's a good chance that Jackson Hole Symposium, I think if we come back to this in a week from now, I think we're going to see a chart higher than that. But that's my opinion, not my certainty, right? I think, and I'm not certain, but I think there's a good chance that by the end of this next coming week, we see all-time highs hit yet again for the S&P 500, just to really make the bears extra angry. And again, I've been getting so many comments, guys, from people who are saying, it's going to crash. This is the end of the world. And I've been getting those comments since I made my YouTube channel in 2018. And every time we get these correction moves, bears get super loud and bulls make a lot of money. And so, again, I am continuously watching the data for something that tells me otherwise. I'm not a perma bull. I've been bearish in the past, but it is rare for me to be bearish, especially when, again, the U.S. economy does not look like it's fallen off a cliff to me. All the indicators that I watch are showing strength. So I've been buying this dip, and that's been paying off. So we'll see. Anyways, we've been spending a lot of time in the S&P 500 today. Let's keep going. I want to talk about gold. So gold took out the highs. What a celebration that was for the bulls out there. Gold making a break through the highs. It was kind of a weird one to me. I'm not going to lie. I would not have guessed that we hit all-time highs on Friday. I'm very happy to see it, but my thought process was, with gold here on a fundamentals front, let's see, where are we at with gold? Gold is getting a bullish rating overall. I shouldn't be surprised that we're hitting all-time highs. If gold is getting a bullish reading on the Edge Finder, that is a positive signal. So COT data, very bullish on gold. Institutional money is very bullish. We'll take a look at that in just a second. Seasonally, it's a good time for bullishness in gold. So there are enough indicators here. I can see it. my point with saying that is that on this past week, we saw a lot of strong U.S. economic data, and that would have told me, confidence in gold going up on, gold usually goes up on fear about the economy, not necessarily very positive economic data. But that being said, there's enough other factors here, like elections in the U.S., like the Middle East, all the conflicts going on there. There's many reasons for a potential breakout here, and maybe just maybe, it's just a consolidation at the highs, and bulls just won out this time. They've tried at this level a couple different times, and bulls were able to just outweigh and outstrength from here. So anyways, huge pop to the upside, very strong price action here. I am a buyer on pullbacks on this one. I don't currently have a position in gold. I've really allocated a lot of my capital to the indices, but I would like to get long on gold. I think that would be a really interesting setup for me. So I'll be looking for pullbacks here on the 4-hour chart. If we drop it down to the 4-hour view here, you might be able to find something. This may be like a 50% retracement from those highs. Yeah, you get that 50% retracement. I actually like that setup quite a bit. And is it chasing the highs? Kind of. But if I were to do it, it would be in a calculated manner. So I'm going to put a stop loss on the trade. I'm going to be looking for a higher risk to reward. But I do think that, gold, when it makes these big breaks through the all-time highs, historically speaking, that is usually a good bullish signal for gold's price action. If you think gold is too high here, you might not have been watching gold long enough. Gold has a history of when it makes big new all-time highs, oftentimes it leads to way more all-time highs. So if we take this as our previous all-time high, look what happened here and I was long for this period. It was an amazing period of my trading career. I wish I could have these sorts of moves all the time. We hit highs here, and then we just hit another high, another all-time high, another all-time high, right? And then we paused briefly, and then we hit another string of all-time highs. My point with this is if you get gold breaking out on a good catalyst, like impending rate cuts, that has the potential to squeeze gold to new heights. And I think that we are in a scenario in which you may not even see a pullback. You may just see this thing trend higher. And 2,500 was my revised yearly target. At the start of this year, guys, my target for gold was 2280, and it nailed that. And I had to revise it, and I revised it to 2500. So gold has hit every target that I had for it this year. It is up 20+% this year. Gold is absolutely killing it. In fact, gold is up more than the S&P 500 this year. So gold bulls out there, it's your year for sure. If you've been making money on the long side, then congrats. It's been awesome. We've caught several of these moves. I did not catch this last move, but in terms of this one, I am a buyer if it pulls back. And if not, I'll just cheer it on and celebrate people who are bullish. So yeah, I don't see any reason to be bearish on gold at this time personally. I don't, maybe if you think that, the conflict in the Middle East is going to resolve, peacefully or something like that, you see some sort of I just can't see making a plan out of that. For me, that's not something that I can predict or know when it's going to happen, but I can look at the economic data and say, yeah, the Fed's going to cut rates. That's bullish for gold and bearish for the dollar. So speaking of the dollar, let's take a look at that. Before we look at the dollar, which, by the way, look at that close. My goodness, that's a closing low for the last, actually going back since, that's a closing low going back since like January of this year. Very interesting. Anyways, let's take a quick look at the commitment of traders data. And somebody asked me cheekily in my comment section, they said, Nick, why would I ever pay for the Edge Finder? You just pull up the COT data every week. And yes, I'm aware there are some of you guys who do that only watch my videos. They skip through just to take a look at the Edge Finder. But please understand, you give me too much credit. I am forgetful sometimes. I don't look through everything. And so if you're somebody who would like a copy of the Edge Finder, there is a trial link available in the description down below. So if you'd like to try it for 30 days, also, I'm going to say this is a little bit, not trying to be hateful or anything, but to be completely honest, if you can't afford to purchase a tool like this at this point or sometime in the future, I'm telling you, if you're trying to cheap your way to trading success, that is a tough road to go down. Trading requires capital, it requires tools, it requires, all sorts of stuff. And if you're trying to spend no money and become a millionaire trader, it's just a rough journey. I'll tell you this so honestly, the services that my team and I have built and provided, They genuinely are worth the money. And if I could go back in time and sell them to myself when I was learning this stuff, I would have been better off. So I genuinely have built, with my team's help, tools, indicators, charts, memberships that I genuinely would sell to my, 17-year-old self trying to learn this stuff. So anyways, let's get into the Commitment of Traders data for this week around. Gold, again, I mentioned earlier, still very bullish on the institutional ownership level, right? On the futures contracts traded, they're 84% long. That is really high. U.S. oil, silver, also U.S. dollar still long too, which I thought was a little bit interesting too. On the flip side, you got the CAD, the CHF, the 10-year Treasury bonds. You've got NZD, AUD, Russell. These things are more on the short side. So if we take a look at the week over week filing, I was interested to see what was going on with gold and the indices. Look at this. Gold saw some buying. So if we break this down here for a second, number of long contracts and number of short contracts traded, we saw an increase dramatically in long contracts and a small increase in short contracts. So long story short, they bought gold last week pretty aggressively. Keep going down the list. They also buy the dollar, or they bought the dollar this past week. Big increase in long contracts. It's a pretty big swing. They also bought some oil, which I think is interesting because oil's been kind of down recently. And then also, this is a little nerve-wracking for me. The S&P 500 actually saw really heavy selling. Fascinating, actually. Okay, this is really interesting, guys. The S&P 500, number of long contracts, they closed a lot of longs and increased a lot of shorts. That definitely doesn't bode well for my positioning because I've told you, if I go take a look at SPY, I'm long this. So if they have been closing longs or even building shorts into this rally, that does make me a little bit nervous about my positioning. However, it is still only a piece of the pie. And this is where, again, new traders who are listening to this, if you're somebody, I just want to watch the COT report because that tells me everything I need to know. Let me just warn you that the COT data is a delayed report by a few days. You get up to Tuesday's data released on Friday. So our software here checks every week. So this is data that pulled in on August 16th, but it represents the Tuesday before that's final data. So there's Wednesday, Thursday, and Friday's data. Their trading activity during that time that we don't know. They could have bought the S&P again since that time that this was reported, right? But it is still worthwhile. But this is why on the Top Setups algorithm, the way we calculate this, COT gets a range of 2 to -2. Right? So it's not taking up the whole score. We look at economic data, we look at technicals, we look at sentiment. If you are somebody who is newer to trading listening to this video and you've made it 27 minutes into this video, then fantastic. Thanks for being here. Again, I'm hoping that your trading career continues to make progress, and all I can say is risk smaller than you think you should. It is a great strategy to risk very small per trade. That is something that I learned the hard way in my early trading years. But really, what I landed on after many years of doing this is that the smaller the position sizing that you're okay with, the better, because you can stomach drawdown better. Anyways, what I was pointing out is a lot of times traders, myself included, when I got into this stuff, I figured out that the Commitment of Traders data existed, and I went head over heels for it, all in on, oh my gosh, that's all I need. But to be honest, that was a poor decision because the COT data is not the holy grail. Retail positioning or seasonality, these things by themselves are not holy grails, guys. None of this stuff is holy grails. If there was a holy grail like, oh, I just need to do exactly what the seasonal chart of the year tells me to do, if that was it, we'd all be billionaires, right? It'd be easy. But it's not perfect. But the point is, what you've got to understand about this stuff is that we're not using it in isolation. This table that you've looked at has been, our engineering, work for the last few years. We are taking in economic data, technicals, sentiment. Let's do a pulse check on all of them using software, and let's build a score for each chart. And then that gives us a bias for each chart. So definitely something to think about. By the way, if you'd like access to the Edge Finder, I mentioned this earlier, there's a trial link in the description. It is not a free trial. It is a paid 30-day trial that you get credited towards your final purchase. If that is something you're interested in, you can apply for it down below in the description. It is a really nice, powerful tool for traders looking to build biases into their trading through sentiment, technical, and fundamental or economic data-based analysis. So highly recommend you check it out. We've worked really hard on this tool the last few years. And just a fun fact, I think we've probably put in upwards of $400,000 or $500,000 worth of investment into building this tool at this time. We've built many, many different features, updates, maintenance. We have a full staff of people behind this product. So when people ask me, Nick, why is the tool not free? Who's paying the bill, the $500,000 bill, right? It is a community-built project. I've said that many times from the beginning. The idea is we have basically given out access to this tool to everyone, charged money for it, and used that money. We have just recycled it back into building the tool as much as possible. And that's why I think it's such a powerful tool. I think it's so good because we've reinvested so heavily into building something like this. Speaking of seasonality, I also wanted to talk about something. So gold seasonally is entering into an interesting time. Same thing for stocks. I'll show you this. So on a last 10-year historical average basis, gold typically sees a positive month in August. And let's check this out for a second, guys. Let's do a seasonality back test really quick for gold, a mini back test. Not a very conclusive one, but look at this. In January, gold missed, right? So let's do this. Did seasonality hold up for gold in January? Seasonality told us 2.32% gains, average gain for gold. I was super bullish, and for good reason. It's the best month of the year on a 10-year basis. And it was wrong, right? So this just goes to show you can't overemphasize anything. February also missed for gold. But then look at this. Directionally, did it get right in March? Yes. Did it get right in April? Yes. Did it get it right in May? Yes. Did it get it right in June? No, it didn't. Right? We didn't get it right in June. Down month when it was expecting a positive gain. July? Yep. August? Unless a miracle happens, yes. So what would that leave you with? That leaves you 5 out of 8. That's a pretty good hit rate, right? 5 out of the 8 times you would have gotten it right. Now, going forward, what that would say is that bearishness in September, October, and November. We're expecting to see a 3-month period of slowness or downtrending for gold, which, again, I'm not necessarily saying I'm going to short gold because of this, because this is one indicator. Again, going back to the lecture I just gave, don't overemphasize any one indicator. Use their combination. That is the whole purpose of the Edge Finder's existence. So September, October, November, we expect more bearishness in the price action. So I'm still bullish on gold, and unless something really seriously changes in the other economic data, I'll probably stay neutral to bullish going into these months. But if we get some change in the data, I could very well see myself getting on the short side of gold if the price action aligns. But again, something to think about. And I also wanted to just, while we're on the subject, take a look at the S&P 500. So we can pull this up and we can see the data here. So again, going off this, it's been pretty accurate, actually even more accurate than gold. It's only missed 1 month. Then it's expecting bearishness in September. So September is expected to be a bearish month. October is about a flat month. And then we go into that bullish kind of end of year period. So something to think about as we cross into the second half of August. I am bullish on the indices, but September is historically a rough month for S&P 500. In fact, going back, I think even like as far as 40 years, it is a negative expectancy. It's a bearish reading in September. So really interesting to see that. But seasonality is something I like to look at a lot. It's one of my favorite indicators on the Edge Finder, but just wanted to mention that. I also mentioned we'd take a look at the dollar index. So let's go look at that a little bit more closely. So also real quick, I just mentioned, I've been trading directly on TradingView for a number of years now. It is so convenient. You can place trades, you can do everything from within it. If you're looking for a brokerage that can do that, there will be several linked in the description down below. If you could do me a huge favor and choose, if you'd like to, one of those brokers, use those links. They are affiliate links, and you'll be supporting the channel here and all the effort that goes into these videos if you sign up with one of those brokers in the description. They can all be traded directly on TradingView, and they're all regulated brokerages themselves. So check them out if you'd like to trade directly on TradingView. Anyways, the dollar index here, price action wise, still looking very weak, right? Price action wise, take a look at the moving averages. We've pretty much all gone under all four of the moving averages here. That's the 20, the 50, the 100, and the 200-day moving average, all signaling more bearishness to come. Excuse me. And if we take a look at this from a price action standpoint, how we closed on Friday, what we've got here is a series of lower highs in the dollar index. And as we close towards the low of this entire range here, that signals to me we may just be doing yet another round of this. 104 breaking out. We talked about that, for weeks. And this dollar weakness for the currency traders out there could lead to, the euro dollar breaking up, right? The pound dollar breaking to the upside, things like that. So what I'd be looking for here for the next wave would be a push through the lows, right? And then a sort of pullback, being more on the short side. And again, this goes off of economic data in the US, seems to be cooling. Interest rates seem to be coming pretty heavily. And we can take a look at the FedWatch tool for that. So we can see expectations for the September meeting coming up are for a 75% chance that we see a single 25 basis point cut, not a 50 basis point cut. I actually love this. And as a stock market bull, this is what I personally prefer. You might say, don't you want more rate cuts? Isn't that good for stocks? Well, yes, but this is where you often hear people chant, well, rate cuts signal a stock market crash, Nick. Don't you know that, you dummy? Oh, man. Guys, I got to say, the comment section recently has been rowdy with the VIX spiking, with all the chaos in markets that usually draws in the newbies to get really loud and tell everybody how the market works, which is incredibly frustrating to those of us who have been around the block for a number of years and have gotten beat up enough times in the market to know it's not that easy, right? So rate cuts are not a signal that the stock market is going to crash by themselves, okay? Are there instances where lots of rate cuts come with a stock market crash? Yes, but they're not the cause of a stock market crash. Rate cuts are just an attempt to ease monetary policy. If monetary policy needs to ease quickly because there is a recession on our hands, then there's a stock market crash usually. But if we can cut rates very slowly because the economy looks pretty okay, it's just showing some weakness but not crashing, rate cuts are not bearish at all. In fact, they're incredibly bullish because the idea is because then they boost economic activity again, right? So if you hear those, that has been making my skin crawl every time I hear that, because people are like, Nick, rate cuts are going to cause the market to crash. And I'm just like, you missed it. You missed the whole point. Rate cuts are just a response to the economy's performance as well as where inflation is at. If you missed the economy and inflation component when you said rate cuts cause crash, you don't know what you're talking about, right? It is not that simple to just say when they cut rates, the stock market crashes. If you've been doing this for a while, you know that as well as I do, and you probably share the same frustration. Anybody who says anything about this stuff is easy or is, obvious, that is a triggering thing for me. I think sometimes people know that and they purposely try and trigger me on my comment section, but it's okay. I've been doing this for a number of years. It doesn't actually, I'm not losing sleep over it. I'm just pointing out that what bothers me about it is I know other people will read those comments and be like, oh yeah, rate cuts cause a market crash. And that will lead them down a bad path in their trading. Let me just encourage you to do the research before you make sort of comments like that. Rate cuts do not cause market crashes. In fact, go do your research on 1995, where the Fed cut rates and we saw the stock market go it went parabolic, right? It went up 175+% on the S&P 500 level before the big crash in the 2001 era. But that's 6 years later when the market crashed. So again, nothing is easy about predicting the future, not in the financial world, not in the real world, nothing, right? It's hard to predict the future. That's why, we put so much work. That's why we're 39 minutes in on a Sunday morning making this video. Stuff's hard. Anyways, this is an extra long video today. If you guys enjoyed it, make sure to hit the thumbs up button. That's all I've got for you today. Last thing I will say is, remember, down below in the description, you can join a bunch of free stuff. You can join our Telegram channel, Discord channel. You can join the Edgefinder tour page. You can find the Edgefinder trial applications. You can join the Discord, all that good stuff. But check out the description on your way out. See if there's anything that pops out to you or would be helpful to you in your trading. Last thing I will say is that if you made it to the very end of this video, seriously, I really appreciate your time. I know you're busy. I know, we're all busy. If you could type the word "end" in the comment section, hit send. I'll try and heart your comment because I really sincerely appreciate you watching my video to the end. I love doing this each week, and I know a lot of you guys really look forward to these videos and hanging out with me. So please feel free to leave your comments on what we discussed here today. If you have any questions, I'll try and answer them. Type "end" if you made it to the very end of this video. And guys, have a wonderful trading week ahead. Thanks for watching.